Hey everybody, Smart Silver Stacker here. Welcome to another live stream. So we got a lot to talk about today. It's a very exciting day in the precious metals markets. We have got the price of gold making some very important gains over some very important levels. This is the chart of silver. Going to be talking about that and why we need to keep an eye on this chart come this Monday. It could be a very important day for both the price of gold and the price of silver. I'm going to tell you why, two important reasons. And also today I want to go over a warning that we have received from none other than the head of the Congressional Budget Office regarding a potential debt crisis in the United States. So this is going to be a good one. Stick around. First of all, let's just take a look at this consolidation pattern that we're seeing on the chart of silver, this symmetrical triangle, which is indicative of a potential breakout. And again, look, this is fairly speculative, what I'm telling you about on Monday. It's not, written in stone. I don't have a crystal ball. I'm hesitant to even mention the timing of any specific market moves, but we'll go over the reasons why I think Monday could be a big day for silver. Now, first of all, today's video is brought to you by SD Bullion, our channel sponsor. They still have this flash sale going on until tomorrow, 99 cents over spot for silver buffaloes if you buy a tube of them. Great deal if you ask me. And again, this might be one of the last times you can get some silver bullion this cheap. Who knows? Not financial advice, just giving you my take on things. But first, let's take a look at the chart of gold. And this is one of the reasons that I think Monday could be a big day for silver. Look at what we've got going on here. New all-time record highs today being put in. Gold now above 2,200. I had drawn a line here at 2,200. Of course, if we zoom out, we've got this big cup and handle formation that we've been talking about on the channel for a long time now. Finally, gold has broken out of that. It seems like there was some resistance at the $2,200 level. You can see this is a weekly chart. So for 3 weeks, we've kind of bumped up against that level. And now, today, we're blowing through it. So this is psychologically very important. Also, today is a very important trading day because it marks the end. Well, one, it's the new all-time daily close. Now, we're about 10 minutes away from market close right now, so I guess we could see a smackdown. But it's looking like we're going to get an all-time high daily close. However, it's also the end of the week, and it is the final trading day of the quarter. So we are putting in new quarterly, weekly, and daily highs today if we get this close where gold is at right now, and it looks like we're going to. So it's very significant on many levels. We're closing above a key resistance level, and I think really it's off to the races. When you look at that cup and handle formation for gold, the upside target based on that pattern for gold would be around $3,100. So, we're still in the early stages of this, but this is a big technical breakout that we are looking at right now. Now, the other reason, so that's one of the reasons I think Monday could be very important for silver. Now, we have got this Market Watch economic calendar, and I do see some folks saying hello in the chat there. Somebody says too many commercials. Well, I don't know what to tell you. Please enjoy the free content that's provided at no cost. Now, this is the Market Watch economic calendar. So tomorrow, even though it's a Good Friday and markets are going to be closed, we're going to be getting a very important piece of economic data, the PCE index, the Consumer Expenditure Index. This is one of the Fed's favorite measures of inflation, and it's coming out on a day when markets are closed. Now, that's very important for gold and silver because inflation reports have been a major driver of price movement in the price of the metals for some time now. And also, tomorrow at 11:30 a.m., Fed Chair Jerome Powell will be delivering remarks and speaking again on a day when the markets are closed. So I really do believe, depending on how this inflation report comes out, that Monday could be the day that we see the silver price break out of this consolidation pattern. It's not guaranteed, of course. I mean, it's probably less than 50% chance. I mean, it's a low probability, however, more so than on your typical day. And given the backdrop that we have witnessed here of exploding debt, we're going to get into that CBO warning here in just a moment, gold already breaking out of its chart, there's a real possibility that we could see that. But, let me know what you think in the chat. Do you think Monday is going to be the day that we see silver breaking out from this trend line? We would need a close in silver about $26 or above to really show that it's breaking out of this consolidation pattern. Put a 2 in the chat if you think that might happen on Monday. Put a 3 if you think there's no chance, or you're pretty skeptical of that claim. And, you should be skeptical about that claim. Nobody can really time markets. I just think that Monday could be an interesting day one way or the other. If the inflation report is particularly hot that we get tomorrow, could be a rough day for the metals on Monday too. Important to note that. But let's get into this story here from the Financial Times. U.S. faces Liz Truss-style market shock as debt soars, warns watchdog. It's actually the head of the CBO, the Congressional Budget Office here. Philip Swagel, director of the Congressional Budget Office, said the mounting U.S. fiscal burden was on an unprecedented trajectory, risking a crisis of the kind that sparked a run on the pound and the collapse of Truss's government in the UK in 2022. Okay, I see a lot of people putting 3s in the chat. Well, okay, you could be skeptical of that claim, and again, rightly so. However, I think ultimately we are destined to see a breakout of the silver price here, following gold, trailing it like it usually does, largely due to this crisis that we're going to examine here in a moment. The debt crisis basically bakes in ultimately much higher prices for both metals, and it's bad news for the U.S. dollar. So if you remember, back in 2022 in the UK, you had this crisis where Liz Truss is like the shortest run prime minister, I think, in Britain's history. And what occurred was she came in, she was going to give a bunch of tax cuts. She wasn't offsetting that with any kind of spending cuts. And it created a sell-off in UK gilts. It's what they call their treasuries, basically would be the equivalent here in the U.S. So UK bonds began to sell off. Interest rates began to spike up. And what it created was an immediate return by the Bank of England to quantitative easing. They had to get in there and begin buying up gilts to drive down the interest rate. And they had an immediate intervention during this crisis. And now you got the CBO, the Congressional Budget Office director, telling us that there's a possibility of a similar event in the United States. Now, he says we're not there yet, but as higher interest rates raise the cost of paying its creditors to $1 trillion in 2026, bond markets could snap back. Now, I don't know where he's getting this data. I mean, the interest on the U.S. debt has already exceeded $1 trillion. I mean, there's a Bloomberg report. I don't have it pulled up right now, but just Google it. Bloomberg report from November of 2023 pointing out interest on the U.S. national debt has already exceeded $1 trillion. So, I don't know what data he's citing here, but we're already at that point, and that's going to be a huge problem moving forward. Now, as we go here, I'm going to examine some of the previous forecasts by the CBO, but the current ones are pretty frightening. I've got Daniel Brent here. Thank you for the super chat, sir. He says, just wanted to say hi and enjoy the content, SSS. Thank you, sir. I appreciate you watching. Really enjoy the level-headed, balanced view. Also, flat earthers using mRNA jet fuel faked the moon landing. Okay, try to get the channel censored. I'm assuming you're referencing some of the commentary that we got yesterday. That's pretty funny, actually. So thank you, Daniel. I appreciate that support. Now, back to a slightly more level-headed examination here of the debt than you might get elsewhere. So this is the current forecast from the CBO. Here's a chart. They put it in this article. So here's where we're at right here. You can see this line. This is the projected percentage of the U.S. debt as GDP. And I mean, basically just a steady climb up is what they're calling for here. By 2050 or so, they anticipate that we're going to be at 150% of GDP with the U.S. debt. Now, I mean, I'm a little skeptical of this projection. Let me know if you think that the debt cycle that we're engaged in, this massive expansion of the debt, can last until 2050. I mean, it's kind of a shocking proposition to me. I don't think it can go on that long, personally, without some kind of a major, restructuring of the financial system, a debt default, or massive inflation. Basically the Federal Reserve coming in and monetizing all of this debt. Let me know what you think. You can put a yes in the chat if you think that the debt can even go along this projected trajectory, or no if you think it's just impossible and that these forecasts are just kind of crazy. I mean, I think they're kind of crazy. To think that we can continue on this path for multiple decades into the future is, I think, magical thinking of a sort. Now, the other thing I want to examine here is you can see this is their forecast of deficits, and we're going to kind of cover this in an interesting context here in a moment. But first, I just want to finish up with this article. So you can see that they're basically forecasting that the deficit is going to stay basically flat. So, I mean, government spending, I guess, will remain where it is relative to incomes, and yet the major part of the increase here is going to be interest on the debt, which is going to be surging. Now, let's move on and examine some of the CBO's previous projections. I think that'll put some of these current projections into context, because as alarming as these current projections are, it's probably going to be much worse in reality. So this is the CBO's report, the Budget and Economic Outlook 2014 to 2024. So this is from 10 years ago, where they were telling us we were going to see moving forward. And I have a chart here pulled up from this report, so you can see that according to their forecast, this is the 2024 column right here. This is where they were telling us back 10 years ago that the current debt held by the public would be $21.26 trillion. Now, I mean, we're above $34 trillion at the moment. So if this is what they were telling us in 2013, it should give you a clue as to what type of projections they tend to give. They tend to wear, the rose-colored glasses when they are looking into the future here at the CBO. I mean, it's a pretty bad picture, right, from 2013 to say, well, we're going to have another $8 trillion in debt. But what we got was a lot more than that. So their projections tend to be off a little bit. They said that we would currently be at a 79.2 debt to GDP ratio in 2024. We're actually well above 90%, close to 100. So again, these forecasts, not so good. Now, this chart here is a visualization of the deficits. And they said from 2014 to 2024, this is what they were forecasting the deficit would look like. Now, this is from this year's report. You can see that the graph has changed a little bit, but this kind of brings us up to speed here. And it's hard to compare these because you can see the format between these two charts is actually different. Here they have surpluses above the x-axis and deficits below, and they've kind of switched that here. So I did a quick work in Paint here. Now, mind you, I'm not a graphic artist by any means, but I've kind of rearranged things to try to juxtapose the two charts, the one from this year's forecast and from last year's, and I've kind of aligned them here, and I've inverted this chart just to give you the comparison here. So this is from the projections from 10 years ago, and this is what they were saying we were going to see, and then below it here, you can actually see what we got. So, I mean, we had this huge spike during the pandemic, 2020, in deficits for 2 years there. Of course, they didn't account for that at all. Now, this section of the bottom chart here, this is what they're forecasting for the next 10 years, and you see they don't have any spikes there or anything, although, the interest, they do show climbing and the deficits remaining very high. But my point is, by showing you these two charts, is we can probably expect this forecast here to be much, much worse, because remember, their forecast from 2014 was very rosy compared to what we actually got. I mean, I guess if you assume there will be no black swan events, there will be no crises, there will be no major problems between now and 2034, then you can go with their projections. But obviously that, I think, is a huge assumption and a clear problem with their forecasting here. I mean, we could have World War III in the next 10 years. I don't think that's too much of a far cry. And any other crisis like the pandemic that just kind of springs into existence, of course, it won't be the real crisis in that case that we have to worry about. It'll be the government response and the massive amounts of money that they tend to throw at these things. But look, the point is here, I mean, their charts are pretty terrifying from the most recent forecasts, and yet, I mean, they don't really paint the whole picture at all. Take a look at this. This is the Fed balance sheet. You know, they're already talking about slowing QT, but if you want to get an idea of what the future looks like regarding the U.S. national debt, it's going to be this chart exploding. We've already seen, this is the spike that we got back in March of 2023 when the banks started to fail. I mean, if you think the banking crisis is over, well, I've got a bridge to sell you because it's not over by a long shot. But, you know, they were more than happy to get in there and expand this balance sheet in the face of a crisis. So any crisis moving forward, whether it be a war, civil unrest, economic crisis, banking crisis, you name it, very likely we're going to see this begin to expand again. Not the least of which reason is you saw most of the additional deficit in the CBO's forecast was from interest payments on the national debt, which have already exceeded $1 trillion. Well, how do you get the interest payments down on the national debt if you don't want to, raise taxes and cut spending? Well, the only way you can do it is to go into the market and buy up U.S. government debt to drop the interest rate, right? Maybe, investors, foreign central banks are not dumb enough to buy U.S. treasuries if the interest rate were low, because I think it's obvious. I mean, Janet Yellen has told us basically that unless we keep borrowing money and raising the debt ceiling, we won't pay our debt back. I mean, she's telling us, there could be a debt default. Last time there was this risk of a debt ceiling standoff. So, you'd have to be pretty stupid to buy treasuries near zero interest rates, but that's what they need to prevent the deficit from exploding. So who's going to get in there and buy up the debt to drive down the interest rate? Who's going to be the buyer at these artificially low interest rates? It's only going to be the Federal Reserve. That means that the expansion of the balance sheet is going to have to move much higher the next time around. And ultimately, I mean, this is very bad news for the dollar, bottom line. I mean, so if you think that gold breaking out to new all-time record highs today is significant, I mean, we haven't seen anything yet. Just by looking at this long-term chart, the price of gold, if you look at how you're supposed to forecast a top for a breakout from a cup and handle formation like this, you take the bottom around $1,050, you subtract it from the top around $2,100, you add it to the top, you can see gold is probably headed north of $3,000, and I mean probably much higher than that. Now, I think a lot of people right now are kind of feeling some negative sentiment towards silver just because it hasn't really moved much yet. But look, if you go back and you look historically, silver tends to lag gold. I want to put together some data regarding that to kind of demonstrate that. So look for that in a future live stream. But that is the case. In most of the big moves for the precious metals over the past 50 years, silver has both outperformed gold and also lagged it. And I don't see any sign that things are different now. A lot of times people will say, well, silver's not a monetary metal anymore. Well, neither is gold. I mean, not since 1971. Yes, central banks do hoard it, but if you ask them why, you ask Ben Bernanke why, he'll say it's just because of tradition. Obviously, there's much more to it than that, but silver will follow gold. I mean, nothing has really changed since 1971 in the relationship between gold and silver, and since that time, when gold runs, silver runs too. So I think the fact that gold has already broken out and silver's so cheap, well, look, I'm looking to stack more at these prices. That's all I have to say. I don't give financial advice, but that's my take on it. And I do think that this Monday is going to be potentially, again, no guarantees here. I mean, it's just something to look out for. But it could be a very interesting day for the precious metals, given the setup that we have. So keep an eye on where gold closes. Well, gold is closed now. It's actually after 4 o'clock. So yeah, we got the close above $2,200. It's in. And keep an eye on what the PCE index says tomorrow and what Jerome Powell says tomorrow. If Jerome Powell waxes dovish, if the PCE comes in line with expectations or below expectations, and look, I get it. I know the inflation numbers are cooked, that's a fact, but investors and markets and trading algorithms, they're all still looking at this stuff, so it's still very important data. But if it comes in below expectations or in line with expectations, I would expect on Monday we'll see some more big moves in gold and silver. If it comes in really hot, if Powell is hawkish, it could be the reverse. We could see a correction. So, let me know what you think about these topics that we covered in today's video about the debt crisis, about the potential for a breakout in the price of silver, about gold's new all-time highs. Smash that like button if you haven't yet. That's one of the best things you can do if you enjoy this content. I really appreciate it. Don't forget to share the video, subscribe to the channel if you haven't yet, and I will catch you next time. Stay safe and happy stacking, everybody. Smart Silver Stacker, out.